Welcome to another podcast of the Refill series. The Refill podcast series brought to you by 10 Leaves. And looking at the sheer weight of the documentation you've hauled into the studio today, I think we're going to need more than just a refill.
Yeah, we might actually need a whole new pot of coffee to get through this one, but it is great to be back.
It's great to have you. You know, usually when we sit down to do a deep dive into regulatory updates, we are looking at something manageable. A tweaked definition here, maybe a slightly adjusted fee structure there. It's usually just renovation work.
Right, minor touch-ups.
Exactly.
Yeah.
But I've been reading through the DFSA's rulemaking instrument number 435, and, well, this feels very different. It feels like someone took a red pen, or maybe a sledgehammer, to the entire anti-money laundering rulebook.
That is a very accurate assessment. I mean, this isn't a renovation. It's a demolition and a total rebuild. The Dubai Financial Services Authority has effectively hit the reset button on the AML framework for the DIFC.
And before we get lost in all the legal jargon, we really need to ground ourselves in the present moment, because the timeline here is incredibly tight. Today is Thursday, February 26, 2026. This instrument was signed just yesterday, on the 25th.
Correct. And if you flip to the commencement date on the very first page of that stack, these rules formally come into force on March 2, 2026.
Which is, yes, next Monday.
Exactly. So if you are a compliance officer in the DIFC, or if you're a banker, if you run a crypto firm, or even if you're in real estate, you effectively have a very, very short window, one weekend essentially, to digest what is a brand new regime.
That is intense.
Yeah.
So our mission for this deep dive is to be the shortcut for you listening. We need to decode this shift from the old regime to the new regime. We need to figure out why the numbers are changing, what the new data requirements actually are, and why the regulator is suddenly so heavily focused on things like proliferation financing.
And perhaps most importantly, we need to discuss the death of the tick box culture. Because if there is one overarching theme in this entire document, it's that doing the bare minimum, just checking the box and moving on, is simply no longer enough.
Okay, let's unpack this. Let's start with what I call the great legal swap. When I first glanced at Appendix 1, it looked like a math problem gone totally wrong. It's just page after page of crossed out numbers and new numbers written in red. What is actually happening there?
I know it looks chaotic, but it's actually a massive harmonization exercise. You have to remember, the DFSA operates within the DIFC, which is a financial free zone with its own civil laws, but it is still fundamentally part of the UAE's broader federal legal ecosystem.
Right.
What we are seeing in the red ink is the old regime, specifically the laws from 2018 and 2019 being formally evicted.
Evicted. That's a pretty strong word.
But appropriate, I think. Look at the text. Everywhere the rulebook previously cited Federal Law No. 20 of 2018, it is struck through. It's gone. It has been entirely replaced by Federal Law No. 10 of 2025.
And the same thing goes for the cabinet decisions, right?
Yes, exactly. The old Cabinet Decision No. 10 of 2019 is out. It is replaced by Cabinet Resolution No. 134 of 2025. Now, to the casual observer, that just sounds like boring administrative housekeeping. Like, oh, they just updated the citation number.
But judging by the serious look on your face, I'm guessing it's not just housekeeping.
Not at all. It signals a major shift in focus. The 2018 law was great for its time, but the 2025 law, Federal Law No. 10, brings a new level of sophistication and severity to the table, and you see that immediately in the definitions.
How so?
If you look at the definition of money laundering in the new DFSA rulebook, it doesn't just say money laundering and terrorist financing anymore. It explicitly pulls in proliferation financing.
Proliferation financing. We hear that term thrown around in high-level policy meetings, but let's clearly define it for the listener. We aren't talking about funding a local crime syndicate here.
No, absolutely not. We are talking about the financing of weapons of mass destruction. Nuclear, chemical, and biological weapons. The new Federal Law No. 10 of 2025 actually has that explicitly in its title. It's the Law on Anti-Money Laundering, Combating the Financing of Terrorism and Proliferation Financing.
It is a mouthful.
It is, but it's highly deliberate. By embedding this into the core definitions of the DFSA rulebook, the regulator is telling us that stopping the funding of a rogue state's nuclear program is now just as central to your daily compliance checks as stopping drug money.
That is a massive escalation in responsibility. It's not just about watching out for shady cash transfers anymore. It's about global security. You're effectively deputizing every bank teller and compliance officer to be part of the national defense.
Precisely. And that escalation trickles all the way down into the nitty-gritty of what you have to actually ask your customers. Which brings us perfectly to the customer due diligence, or KYC section.
This is the part that really jumped out at me. Rule 7.3.2. I feel like every time we do a deep dive on AML, the list of things you need to ask a client just gets longer. It used to be just a passport copy and a handshake.
Those days are long, long gone. And 2026 is tightening the screws even further. Let's look at natural persons, individual human beings. Previously, you needed the standard stuff: name, date of birth, place of birth.
Right, the basics. But now I see two new additions that are underlined in the text here: nationality and legal domicile.
Yes. And legal domicile is the really tricky one.
How so? Isn't that just where I live? Like, if I'm renting an apartment in the DIFC, isn't that my domicile?
Not necessarily, and this is exactly where a lot of firms are going to trip up on Monday morning. The guidance clarifies this distinction. You still need the current residential address, which is where you sleep at night. That's where your Amazon packages go.
Okay.
But legal domicile refers to the jurisdiction that a person regards as their permanent home, or where they have their closest legal ties.
Okay, help me visualize this. Give me a concrete example.
Sure. Imagine a French national who has been working in Dubai for 5 years as a consultant. Their current residential address is undoubtedly Dubai, but their legal domicile might still be France, especially if they intend to return there eventually, if their will is executed under French law, or if their primary family ties remain there. Or maybe they are a non-dom resident of the UK.
So as a compliance officer, I can't just take a local utility bill and call it a day anymore. I need to understand the customer's permanent legal footing.
Correct. The DFSA is requiring firms to firmly distinguish between where you are right now and where you belong legally. Because when it comes to tax evasion and complex money laundering schemes, that distinction matters immensely.
And speaking of tax, that naturally brings us to the updates for body corporate companies.
Mm-hmm.
I noticed the list for corporate KYC has grown significantly too.
It has. It's no longer enough to just get the certificate of incorporation. Rule 7.3.2, Section 3 now demands the legal form, the unique reference number, and this is the really big one, the tax registration number.
The TRN. Why is this such a big deal, though? Most of us have tax numbers now. It feels like just another string of digits to type into a database.
It's significant because it effectively kills the silo between AML and tax compliance. For a long time, banks looked for dirty money, and tax authorities looked for tax evasion, and they didn't always talk to each other. By requiring the TRN as a mandatory standard KYC field, the DFSA is creating a data point that connects the financial flow in the DIFC directly to the global tax transparency network.
So it makes it much, much harder to hide behind a shell company.
Right.
If you have to provide a valid tax ID, that ID links back to a specific jurisdiction that is very likely sharing data with the UAE.
Exactly. You can't just be a company in the cloud anymore. You have to be a taxpayer somewhere. And to really reinforce that, look at the new requirement for foreign companies.
Oh, this was fascinating. So if I'm onboarding a company from, say, the British Virgin Islands or the Cayman Islands.
Yeah, you now specifically need the name and address of its legal representative in the UAE.
That effectively kills the ghost company model, doesn't it? The whole idea that a foreign entity can open an account here, but have absolutely zero human footprint on the ground.
It really does.
Okay.
The regulator's basically saying we need a name. We need a physical address. We need someone here within our reach who is answerable for this entity. If things go south, they want a door they can physically knock on in Dubai, not just a P.O. box in the Caribbean.
Feels like the net is tightening. Everything is becoming much more granular.
Granular is the perfect word. But there is also a fascinating philosophical shift in how they want you to look at ownership.
You're talking about the beneficial owner section.
I am. This is probably the most intellectual shift in the entire document.
This part actually made me laugh a little because the regulator sounds almost annoyed. They have this section where they seem totally fed up with people gaming the system.
You're looking at Rule 7.3.8, specifically the guidance on identification. For years, the global industry standard has been the 25% rule. If someone owns 25% or more of a company, they are a beneficial owner, a UBO. If they own 24.9%, you don't have to identify them.
Right. That's the golden rule of compliance. Everyone knows that. Keep it under 25 and stay invisible.
Well, the DFSA is saying stop it.
Really? Just like that.
The new guidance explicitly says that firms should not set fixed percentage thresholds without, and I quote, objective and documented justification.
So I can't just say my internal policy is 25% anymore.
No. They call this a substantive approach. They want you to focus on control, not just raw ownership percentages. The text warns that an overly formal approach, meaning just rigidly sticking to the math, allows criminals to game the system by deliberately structuring their holdings to sit just below the threshold.
Which is exactly what happens in the real world. You see these complex structures with 4 guys each owning 24% or 5 guys with 20%, and suddenly nobody's the owner on paper. The form comes back totally blank.
And the DFSA is calling time on that. They are saying, we don't care about the math, we care about the reality. Who actually appoints the board of directors? Who holds veto power? Who is actually pulling the strings behind the curtain?
That is a much, much harder question to answer than just asking, how many shares do you have?
It absolutely is. It forces the compliance officer to be a detective, not just a data entry clerk. If you stick to a rigid percentage without analyzing who is actually in control, you are arguably non-compliant under this new guidance.
That is going to cause some serious headaches. It's so much easier to just check a box.
Compliance isn't meant to be easy, it's meant to be effective. And to back this up, they are requiring more data on these beneficial owners too. For beneficial owners, you now need their identity number and tax registration number. Again, pinning them down to a very specific, traceable, legal identity.
So we've covered the shift in laws, the tighter KYC, and the crackdown on beneficial ownership structures. But we really can't talk about finance in 2026 without talking about crypto, or, as the DFSA calls it in the text, virtual assets.
Of course. And this update integrates the federal requirements for virtual asset service providers, or VASPs, directly into the rulebook. It's no longer a side note or an appendix, it's the main text.
I'm looking at Rule 9.38.4. Talks about crypto token transfers. There's a specific dollar figure here that caught my eye. $1,000.
That is the new travel rule threshold.
$1,000 isn't a lot of crypto. That's a fraction of a Bitcoin.
It really isn't. But if a transfer is equal to or exceeds $1,000, the authorized person, meaning the crypto firm in the DIFC, must conduct due diligence on the counterparty VASP.
Let me make sure I understand this. So if I'm sending $1,500 in Bitcoin from my DIFC broker to an exchange over in Singapore, my broker has to check out that Singaporean exchange.
Yes. They need to identify and assess the money laundering risks associated with that specific transfer. They can't just send the money into the void. But it actually goes further than that. They reference Article 36 of the new Cabinet Resolution number 134. You have to obtain accurate information on both the sender and the beneficiary and transmit that information to the other VASP immediately and securely.
It's kind of like checking a bag at the airport. You can't just throw the bag on the plane and hope for the best. The tag with my name and my final destination has to physically go with the bag.
That is a great analogy. The data must travel with the asset. If the data doesn't arrive, or if the counterparty VASP is deemed risky, the transaction simply shouldn't happen.
And immediately is a very tough word in the tech space.
It implies real-time transmission. It forces crypto firms to adopt messaging standards that are just as robust and instantaneous as the SWIFT system that traditional banks use.
And speaking of risky transactions, the sanctions section has been heavily beefed up too.
Significantly. The new rules explicitly require screening against United Nations Security Council lists, which is fairly standard, but the guidance now points directly to the EOCN.
The Executive Office for Control and Non-Proliferation.
Correct. The guidance reminds firms that under the new cabinet resolution, they must formally register with the EOCN, screen their databases against the EOCN lists, and apply freezing orders.
Freezing orders? That sounds quite dramatic.
It is a critical part of the UAE's defense against proliferation financing. If the EOCN says freeze, you freeze. Immediately.
Without a court order.
Without waiting for anything. The new rules make it crystal clear that you need the internal systems in place to do that instantly. You cannot wait 3 days for a committee meeting while the funds are quietly moved offshore. Speed is the absolute essence of compliance here.
Right. So speed is of the essence. Now, I want to pivot to a group that often feels left out of these hardcore banking discussions, but is very much in the crosshairs here, the DNFBPs.
Designated non-financial businesses and professions. We're talking about lawyers, accountants, and specifically real estate developers and agents.
Real estate is always a hot topic in Dubai. There is a subtle change in the definition of a real estate developer or agency in this update.
Yes. Previously, the definition covered transactions involving the buying or selling of real property. Now, it explicitly says carrying out transactions for or on behalf of a customer.
For or on behalf of, that implies an agency relationship.
It creates a much clearer link. If you are acting as an intermediary in any capacity, you are covered by these rules. But the bigger update for DNFBPs is actually found in the registration process itself, Rule 15.1.2.
This is the fitness and propriety test.
Exactly. To register as a DNFBP in the DIFC now, you must demonstrate that you are fit and proper specifically to perform AML functions.
What does that actually mean in practice? Let's say I'm a real estate agent. My job is to sell luxury penthouses, not to be a private investigator.
The DFSA disagrees with that premise. They are saying you need adequate resources. The guidance points straight to Article 21 of the new Cabinet Resolution number 134. You can't just be a good salesperson anymore. You need to show the DFSA that you have the systems, the trained staff, and the robust policies to actually catch money launderers. If you can't demonstrate that resource capability, they might simply not register you.
That is a very high bar. It's demanding the absolute professionalism of the compliance function, even for non-financial businesses.
And if you fail to meet that bar, the penalties have completely changed too.
I saw that in the text. The legal reference points have moved.
Yes. The DFSA's power to impose fines and bans is now tied to Article 17, Section 1 of Federal Law Number 10 of 2025. Previously, it was Article 14 of the old 2018 law.
So it's the same power, but a new legal trigger.
Same power, but arguably a much more robust framework backing it up. The alignment with 2025 federal law means the DFSA is enforcing the very latest, most stringent national standards. It clearly signals to the world that the DIFC is in lockstep with the federal government's broader crackdown on illicit finance.
So looking at the clock, we've gone through all the red ink. We've seen the numbers formally flip from 2018 to 2025. We've seen the rise of proliferation financing as a top-tier threat. We've seen KYC demanding tax IDs and legal domiciles. And we've seen the substantive approach trying to finally kill off the tick box culture.
That is a very fair summary of a very dense document.
But here is my ultimate question to you. It's February 26th. This whole thing starts on March 2nd. If I'm listening to this right now and I manage a compliance team, or I'm senior executive officer, what is the one thing I need to do this afternoon?
You need to audit your onboarding forms right now, today. If your customer intake form doesn't have a specific field for tax registration number, legal domicile, or legal representative in the UAE, you're going to be technically non-compliant the moment you open your doors on Monday morning.
That is a genuinely scary thought. You have about 48 hours to completely change the plumbing of your customer onboarding process.
It is going to be a very busy weekend for a lot of people. But beyond just updating the forms, you urgently need to brief your team on the substantive approach. You need to tell your analysts, stop just looking for 25%, start looking for actual control. That is a fundamental training issue, not just a paperwork issue.
It's a complete mindset shift.
It is. The regulator is effectively saying, we know the tricks. We know all about the 24.9% ownership structures. We know about the ghost companies in the Caribbean, and we have changed the rules to catch them.
That's a powerful message. It feels like the era of being technically compliant but actually shady is finally coming to an end.
Or at the very least, it is becoming much harder and much, much riskier to sustain.
Well, on that note, we're going to wrap up this deep dive into the DFSA's rulemaking instrument number 435. It's a lot of changes, a lot of new numbers, but the core mission remains exactly the same. Yeah. Keeping the financial system clean.
And keeping it completely safe from proliferation risks.
Absolutely. Now, before we go, I want to leave you, the listener, with a thought to chew on. We talked extensively about the shift from ownership percentages to actual control.
Yes, the substantive approach.
Exactly. It makes me wonder, if you are a compliance officer and your entire multi-million-dollar AML software system is hard-coded to flag only beneficial owners above 25%, are you actually compliant under these new rules? Or are you, by relying blindly on that software, accidentally gaming the system yourself?
That is a deeply uncomfortable question.
And definitely one worth answering before the DFSA auditors show up at your door. That's it for this deep dive. Thanks so much for listening.